In this video, you're going to learn one of the most important concepts in trading: how to place your stop loss intelligently and avoid one of the biggest challenges most traders constantly struggle with: getting stopped out. Because one of the most frustrating experiences in trading is watching price hit your stop loss, only to continue moving perfectly in your original direction afterward. And the truth is, this happens to traders far more often than they realize. Not necessarily because their analysis was wrong, but because their stop loss placement was. So in this video, we're going to break down why stop losses keep getting hit, why the market constantly targets certain areas, how liquidity actually moves price, and how to place your stop loss in a logical way, instead of becoming the liquidity being taken. And this is exactly why understanding liquidity is so important. Because once you understand liquidity, how it forms, where it forms, and the different ways it appears inside the market, you begin understanding where price is most likely trying to move next. And that completely changes the way you place your stop loss, because now, instead of placing your stop loss emotionally, or placing it in obvious areas where most traders place theirs, you begin placing it based on liquidity itself. And this is exactly how traders begin avoiding unnecessary stop outs. Because one of the biggest mistakes most traders make is placing their stop loss directly inside liquidity, below obvious lows, above obvious highs, around equal highs and equal lows, or around areas where liquidity naturally exists. And the problem is, once liquidity forms in those areas, price very often seeks those areas before continuing in its intended direction. Which is why many traders get stopped out, even when their directional analysis was actually correct. So before learning how to place a stop loss correctly, we first need to understand how liquidity forms in the first place. Now, liquidity does not exist in only one form. First, there is engineered liquidity. Engineered liquidity is liquidity the market creates through structures traders emotionally trust, as mentioned before, like equal highs, equal lows, trend lines, support, and resistance. And once large numbers of traders begin reacting to the same areas, liquidity naturally begins forming around them. This is why these structures become major liquidity zones, because traders repeatedly place entries, stop losses, and emotional decisions around the exact same areas. This is why equal highs and equal lows become powerful liquidity zones. And this is also why trendline liquidity sweeps happen so often. Because the market understands collective retail behavior. But while engineered liquidity forms around obvious external structures, internal liquidity forms inside price delivery itself. Meaning, instead of forming around visible retail structures, it forms inside the movement of price itself. And one of the clearest examples of internal liquidity is the fair value gap, whether bullish or bearish. A fair value gap is essentially an imbalance created when institutions enter the market aggressively with large amounts of volume. And because price moves so aggressively during that expansion, it often leaves behind an inefficiency inside price action, almost like a gap in delivery. And very often, price later returns to rebalance or partially fill that inefficiency before continuing its move. And now let's move into another form of liquidity. It is external liquidity. External liquidity, whether be sell or buy side liquidity. An external liquidity is usually found around swing points, swing highs and swing lows, areas where large pools of stop losses naturally accumulate. A swing high or swing low is usually formed when a candle becomes higher or lower than the candle surrounding it from both sides. Which is why these areas naturally become important liquidity zones. But what makes liquidity truly powerful is not just understanding each type individually. It's understanding the relationship between them. Because price constantly moves from one form of liquidity toward another. Sometimes price reacts from internal sell-side liquidity before continuing toward external sell-side liquidity. And other times, price sweeps external sell-side liquidity first before returning toward internal sell-side liquidity again. The same concept applies to buy-side liquidity. Price can react from internal buy-side liquidity before continuing toward external buy-side liquidity. Or take external buy-side liquidity first before returning toward internal buy-side liquidity afterward. And this relationship between internal and external liquidity is one of the clearest proofs that the market is not random. Because price is not moving aimlessly. It is delivering with precision from liquidity toward liquidity. And before understanding liquidity, many traders believe the market is random mainly because of stop losses. You enter a trade, price starts moving in your target, everything looks perfect, then suddenly the market retraces, takes your stop loss, and moments later continues moving perfectly in the exact direction you originally expected. And after experiencing this enough times, most traders begin believing that the market is manipulated, that trading is pure luck, or even worse, that the market is specifically targeting them. But what if the problem was never your analysis? Because if you carefully review most of the trades where your stop loss got hit, you'll notice something interesting. In many cases, price eventually continued moving in the exact direction you originally expected. Which means the issue was not always your market direction analysis. The real issue was often where you placed your stop loss. And this misunderstanding is exactly what creates one of the most dangerous beliefs in trading, the belief that the market is random. Because when traders repeatedly experience the same cycle, getting stopped out, then watching price continue exactly as expected, they slowly begin treating trading like gambling. Winning feels random. Losing feels random. And eventually, they stop trusting analysis completely. But ironically, stop losses being repeatedly targeted is actually one of the strongest proofs that the market is not random at all. Because randomness does not create repeated behavior. And randomness does not repeatedly target the exact same areas with the exact same psychological patterns. What you're actually witnessing is the psychology of the market, a deep understanding of retail behavior. Because the market understands exactly how most traders think. It understands emotional decision-making. Where they enter and where they place their stop losses emotionally, below obvious lows and above obvious highs. And most importantly, it understands where liquidity accumulates. And this is exactly why stop hunts happen so often. Large market participants need liquidity to enter and exit positions, and since most retail traders place their stop losses in obvious areas, those areas naturally become targets. And because human psychology repeats itself, liquidity repeats itself too. And unfortunately, this repeated experience pushes many traders into another dangerous mistake, trading without a stop loss. Because after getting stopped out enough times, many traders begin believing that removing the stop loss is somehow the solution. But that is one of the fastest ways to destroy your trading account. Because risk management is the only reason traders survive long term. A trader without risk management does not survive in this market. So the solution is not avoiding stop losses. The solution is learning how to place them intelligently. And this is where most traders completely misunderstand the purpose of a stop loss. The goal of a stop loss is not simply to lose less money. The real purpose is to define the point where your trading idea becomes invalid. A level where, if price reaches it, your original analysis no longer makes sense. That is the real purpose of a stop loss. And before placing any stop loss, you should always ask yourself one important question: is it logical for price to retrace to this area? Because if the answer is yes, then that is probably not the best location for your stop loss, because retracements are normal. Liquidity sweeps are normal. Temporary pullbacks are normal. The market does not move in straight lines. It constantly expands, retraces, collects liquidity, then continues moving. And this is exactly why many traders get stopped out even when their directional analysis was actually correct. Not because the idea itself was wrong, but because the stop loss was placed inside normal market movement. And once traders truly understand this, they stop panicking during every pullback. Because many traders make another emotional mistake during retracements, early exits. The moment price starts pulling back slightly, fear immediately takes over. So they close the trade early, preferring a small profit over uncertainty, only to watch the market continue moving perfectly toward their original target without them. And that creates frustration, regret, and emotional trading behavior. Because now the trader is no longer reacting logically. They are reacting emotionally, and emotional trading usually leads to impulsive decisions, overtrading, revenge trading, and inconsistent results. But once you understand liquidity properly, everything starts looking different. You stop reacting emotionally to every retracement. You stop believing that the market is personally attacking you. And you begin understanding that price movement has structure, logic, psychology, and intention behind it. Because the market is not random. And if you do not understand where liquidity exists, there is a very high chance that you become the liquidity being taken. And that's exactly why understanding liquidity changes the way you see the market. So if you found this video valuable, make sure to like, subscribe, and turn on notifications for more simple and educational trading content about liquidity, ICT, and market psychology. And if you have any questions or topics you want explained next, feel free to leave them in the comments. See you in the next video.